Microsoft just reported strong growth, but the real story is AI. With cloud demand surging and massive investments in artificial intelligence, something big is happening. Let's break down what investors need to understand. We are discussing on the FinTalk channel.
Imagine spending like $342 million every single day.
I mean, it's almost hard to wrap your head around that number.
Right, for 90 days straight. And, you aren't acquiring trendy startups. You aren't running massive global marketing campaigns. You are just pouring concrete, laying thousands of miles of fiber optics, and building dedicated power substations.
Yeah, heavy industrial stuff.
Exactly. So, welcome to the deep dive. Today, we are looking at a financial document that completely redefines what a software company actually is.
It really does.
Our mission is to decode Microsoft's Q3 fiscal year 2026 financial results, the quarter that ended March 31st, 2026. Because for you, the listener, this isn't just about reading a balance sheet to see who made money.
Right.
We're going to translate these numbers to understand the physical and digital architecture of basically an entirely new global economy.
Because that scale of spending, it completely changes the conversation. When you look closely at these specific sources, you realize we are well past the theoretical phase of artificial intelligence.
Oh, absolutely.
This report is a window into the heaviest, most resource-intensive infrastructure project of our lifetimes. And it's being built in real time, just kind of disguised as a standard corporate earnings report.
It's wild. To give you a baseline for the sheer scale we're dealing with here, the top-line numbers are almost difficult to process. Overall, quarterly revenue for Microsoft hit an astonishing $82.9 billion just in one 3-month period. That's an 18% increase from the same time last year. And their net income reached nearly $31.8 billion, which is up 23% on a GAAP basis.
Right, meaning under standard accounting principles before they strip out any special circumstance.
Exactly.
And when a company of that massive size is still growing revenue by 18% and net income by 23%, it signals a fundamental restructuring of consumer and enterprise behavior.
Yeah, you don't get that just by tweaking things.
No, you simply do not get that kind of growth at an $82 billion scale by just optimizing your existing software or making things run slightly better. You only get those numbers by capturing an entirely new market.
Okay, let's unpack this. Because the question becomes, how does a 4-decade-old legacy behemoth suddenly grow like a nimble Silicon Valley startup?
Right.
And the answer, the hyper-growth engine driving this entire vehicle, is their artificial intelligence business. The number that absolutely jumps off the page in this report is that Microsoft's AI business has officially surpassed an annual revenue run rate of $37 billion.
Which is just, the raw dollar amount is impressive, obviously, but the velocity is the actual story here.
Yeah.
That $37 billion run rate comes with a 123% year-over-year growth rate.
123%. I mean, that is the engine right there.
Oh, yeah.
But what I find fascinating is how management actually talks about it. CEO Satya Nadella has a specific quote in the report. He stated their goal is to deliver cloud and AI infrastructure that empowers businesses to, and this is a quote, evil max their outcomes in the agentic computing era.
Such an interesting phrase.
Right. Now, evil max means maximizing their evaluation metrics, basically pushing their operational efficiency and yield to the absolute mathematical ceiling. But it's that second phrase, agentic computing era, that really requires some dissection.
What's fascinating here is that this is a profound shift in computer science.
Yeah.
For the last 30 years, we have basically been living in the reactive computing era.
Yeah, think of legacy software like the standard programs you and I have used forever as a really advanced calculator. It's incredibly smart, but it just sits there on your desk waiting. It does absolutely nothing until you manually punch in the numbers, define the formula, and hit the equals button. It requires human initiation at every single step of the workflow.
But an AI agent operates on a completely different paradigm. You don't give an agent a rigid set of inputs. You give it a broad objective.
It's like hiring a highly autonomous chief of staff. You don't tell the chief of staff how to format the spreadsheet. You say, we have a supply chain bottleneck in Southeast Asia. Find the disruption, evaluate 3 alternative shipping routes, negotiate the freight costs with our vendors, and reroute the inventory to minimize delays.
Exactly. In the agentic era, the AI independently figures out those steps. It interacts with the necessary databases, emails the vendors, and executes the task entirely on its own.
It actually has agency.
It has agency. And tying this back to the financials, that 123% growth tells us something critical about the broader market. Like
Wow.
18 months ago, Fortune 500 companies were running isolated pilot programs with AI.
Just testing the waters.
Right. The fact that Microsoft is recognizing a 37 billion run rate means that experimental phase is definitively over. Enterprises are now embedding these autonomous agents into their core daily operations. They're trusting software to negotiate and execute without a human hand on the steering wheel.
But, an autonomous AI agent analyzing global supply chains can't just process that complex task locally on your corporate laptop.
No, definitely not.
The sheer compute power required means these agents have to live somewhere else. They require mind-boggling amounts of processing power. And that necessity drives us directly into Microsoft's cloud segment, which serves as the physical engine room for this entire AI revolution.
The financials reflect that dependency perfectly, too. Let's look at the intelligent cloud segment. The revenue there hit $34.7 billion for the quarter.
Which is massive.
That's a 30% increase.
And within that segment, there's a specific metric that stands out even more. Azure and other cloud services revenue increased by a staggering 40%. But let me push back on this narrative for a second, because I think we need a healthy dose of skepticism here.
Okay. Sure.
Are enterprise companies actually getting a tangible return on investment from these AI agents right now, or are we just watching a massive corporate FOMO cycle?
That's a really good question.
Like, are companies just panic buying Azure server space because their board of directors is demanding an AI strategy and thereby just artificially inflating these cloud numbers?
It's a fair challenge, and there is undoubtedly some initial panic buying in the broader market. You always get that. But you have to look at the mechanism of how AI and cloud interact to see why this 40% growth is structural and not just hype.
Okay, walk me through that.
So Microsoft's overall cloud revenue hit $54.5 billion, which is up 29%. When a company deploys an advanced AI agent, they aren't just renting a standard hard drive in the cloud to store, like, PDF files.
Right.
They are renting access to massive, highly specialized clusters of graphics processing units, or GPUs.
Because GPUs can handle thousands of calculations simultaneously, which is exactly what neural networks require.
Exactly. You cannot deploy enterprise-grade AI without tapping into that specific hardware architecture. The cloud is the exclusive entry ticket. You either build your own multi-billion-dollar GPU data center,
Which is impossible for, 99% of companies?
easily, or you migrate your entire operational database into Azure so the AI can securely interact with your data. The AI deployment is the magnet pulling the data into the cloud, and the cloud provides the compute power that allows the AI to function.
It's a closed-loop ecosystem.
Entirely closed loop.
Which means hosting all this demand isn't achieved by simply sitting at a keyboard in Redmond and pushing a software update. It requires raw physical infrastructure.
Yeah.
And here is where we get back to that 342 million a day figure from the intro. When you look at the cash flow statement, you find the most aggressive metric in the entire report, which is their capital expenditure.
This is wild.
Here's where it gets really interesting. Microsoft spent $30.8 billion in just one quarter on additions to property and equipment.
$30.8 billion in 90 days. Wall Street traditionally punishes massive capital layouts because it aggressively eats into free cash flow. When a software company starts acting like a heavy industrial construction firm, investors usually panic.
Right, because they aren't just buying servers. They are buying land. They are securing immense amounts of water for the liquid cooling systems because these GPU clusters run incredibly hot. And they're building dedicated power infrastructure just to keep the lights on. It's like building a small country every quarter. But why? Why risk the wrath of investors to spend that much cash that fast?
This raises an important question, right? And the answer is because they are securing the foundational resource of the new economy. Let's step away from the tech jargon for a second. Think about this like securing water rights in a desert.
Okay, I like that analogy.
In the agentic computing era, the AI models and the software interfaces are like a newly built city. But raw compute power is the water. It absolutely does not matter how brilliant your AI model is. If you don't own the underlying compute capacity to sustain it, your city dies.
Wow.
Microsoft is spending $30.8 billion a quarter to basically buy up the reservoir.
Oh.
They are betting that whoever holds the most physical compute capacity will dictate the terms of the entire industry for the next decade.
But I mean, a $30.8 billion quarterly bill is still a terrifying gamble. If you are pouring that much concrete and buying that many processors, you need absolute certainty that the customers are actually going to show up to rent them.
Right.
How does a CFO justify this incredible expense to analysts without causing a massive sell-off?
By pointing to the ledger of future money that is already legally locked in.
And that brings us to a metric that sounds incredibly dry, but is actually the linchpin of this entire strategy. It's the commercial remaining performance obligation, or CRPO.
Yeah, that's CRPO.
We can just call it what it is. It's a massive corporate IOU. This represents the money that enterprise customers have legally contracted to pay Microsoft in the future, but which hasn't been recognized as revenue yet because the cloud services haven't been fully delivered.
If we connect this to the bigger picture, it is their backlog of guaranteed future revenue.
Okay.
And that metric increased by an unbelievable 99% year over year.
It reached a record-breaking $627 billion.
It's staggering.
$627 billion in contracted future revenue. But hold on, let's play devil's advocate again. In the technology sector, 3 to 5 years is an absolute eternity. Entire paradigm shift in 36 months.
True.
How ironclad are these enterprise contracts, really? Like, if the broader economy tanks or if a new competitor offers cheaper compute, can a Fortune 500 company just renegotiate or walk away from these commitments?
Well, the contracts are remarkably sticky, and here is why. The dynamic has shifted from a buyer's market to a seller's market for compute capacity. The chief information officers at these massive enterprises, they're looking at their own internal roadmaps.
Right.
They see that they will need 5 or 10 times the compute power by 2028 just to keep their AI agents running. Their biggest fear isn't overpaying. Their biggest fear is being caught in a global GPU shortage where they literally cannot buy the compute power they need to compete.
So they're essentially hoarding resources.
Yes, exactly. They are willing to sign these massive multi-year legally binding contracts today to reserve rack space and compute capacity at a locked-in discount.
That makes perfect sense.
It's a mutual dependence. The enterprises get guaranteed access to the water in the desert, and Microsoft takes those $627 billion worth of contracts to Wall Street and says, yes, we are spending $30 billion this quarter on property and equipment, but look at the $600 billion in the vault, subsidizing the build-out.
It completely de-risks the capital expenditure.
Oh, right.
It's a phenomenal mechanism. But looking at these numbers also forces us to confront an incredible contrast. We're spending all our time talking about GPU clusters, billion-dollar enterprise contracts, and autonomous cloud agents. But what about the Microsoft you and I grew up with?
Yeah, the classic Microsoft.
Right, because the contrast between this invisible commercial infrastructure behemoth and their legacy consumer identity is incredibly stark.
We really are looking at a tale of 2 different eras operating under one corporate roof.
So let's look at those legacy segments. The report breaks down revenue into a few different buckets. The productivity and business processes segment, which is the modern evolution of their core software like Microsoft 365, Word, Excel, and LinkedIn, that segment grew nicely.
Yeah, that's their bread and butter.
It was up 17% to $35 billion, which makes total sense. Businesses still need productivity tools, and Microsoft is actively infusing AI into those platforms. But then you look at the segment called more personal computing.
This is the division that houses the consumer-facing hardware, the operating systems, and gaming.
And that segment actually decreased by 1% down to $13.2 billion. When you drill down into the specifics within that bucket, the trend becomes undeniable. Windows OEM and devices revenue, meaning the actual Surface computers and the Windows licenses sold to companies like Dell and HP, that revenue decreased by 2%.
Right.
And Xbox content and services revenue dropped by 5%. Now, we know they've been shifting their focus to the cloud for a decade under Nadella, so a slight dip isn't shocking. So what does this all mean? Seeing the consumer hardware actually shrink while the cloud division explodes by 40% feels like we are watching the final official end of an era.
It is the final nail in the PC on every desk philosophy that basically founded the company. And the mechanisms behind that decline are pretty clear to anyone watching the broader tech landscape. The consumer PC replacement cycle is lengthening drastically.
Oh, absolutely.
People are keeping their laptops for 5 or 6 years because a web browser and cloud apps just don't require the latest hardware. And on the gaming side, the physical Xbox console is becoming less relevant as cloud gaming allows you to stream high-end titles directly to a smart TV or mobile device.
Though it is worth noting that within that personal computing segment, search advertising revenue did manage to grow by 12%. But the core physical hardware and traditional operating systems are fundamentally pulling back. They've effectively traded the desktop for the data center.
They really have. And while we are discussing the financial transitions that solidify this new identity, there is a crucial detail tucked away in the non-GAAP definitions of this report regarding their massive partnership with OpenAI.
Right, they invested billions into OpenAI, and for a while that was taking a serious toll on their bottom line. We need to look at the non-GAAP numbers to see that clearly.
Yeah, it's hidden if you don't look closely.
For you listening, companies use non-GAAP measures to strip out one-time accounting quirks, restructuring costs, or in this case, the fluctuating equity losses from external investments. It allows us to see the actual operational reality of the core business.
Exactly. And if you look back at Q3 of 2025, so just 1 year ago, the net losses from their equity investments in OpenAI created a massive drag on Microsoft's net income. It decreased their net income by $583 million in that single quarter.
$500 million.
Yeah. They were absorbing massive financial bleeding to fund OpenAI's research and development.
Over $500 million, essentially acting as an anchor on their profits.
But look at the current quarter, Q3 2026. That financial bleeding has essentially flatlined. The net losses from the OpenAI investments resulted in a decrease in net income of just $14 million.
Wow.
It went from a $583 million drag down to a negligible $14 million.
That completely changes the margin profile. So not only is their internal proprietary AI business generating a $37 billion run rate with 123% growth, but the massive financial burden of carrying the OpenAI partnership through its most expensive research phase has basically neutralized.
They have stabilized the external costs just as the internal revenue is hitting hypergrowth. It is an incredibly formidable position. The physical infrastructure is aggressively expanding, the strategic partnerships are financially stabilizing, and the future cloud revenue is contractually locked in.
Which brings us to the summary of these massive tectonic plates shifting under the technology landscape. Just to pull all of these threads together for you, we are looking at an organization experiencing a 123% surge in AI revenue and 40% growth in Azure cloud services.
Massive numbers.
This digital explosion is physically enabled by a staggering $30.8 billion infrastructure spend in just 90 days. And that massive capital bet is financially secured by a record-breaking $627 billion in legally binding future contracts.
Yeah.
All of this is happening while the legacy Windows and Xbox divisions quietly shrink into the background, marking the end of the personal computing era and the dawn of commercial cloud dominance.
And this is precisely why we do more than just read the top-line numbers. You have to consider how these macro-financial shifts directly dictate the tools you will be forced to use in your own career over the next 5 years.
Exactly.
When a coalition of Fortune 500 companies locks in $627 billion in contracts, they are permanently dictating the software landscape you will navigate. The transition from reactive tools to proactive, autonomous agents isn't a future prediction anymore. It is fully funded, fully contracted, and fully underway.
It really reframes the entire earnings report from a look back at the past into a blueprint for tomorrow. And that leaves you with a final lingering thought to mull over as we wrap up today.
Let's hear it.
If Microsoft and its massive enterprise clients have already legally locked in $627 billion to power this agentic computing era, what exactly is our digital landscape going to look like when all of those autonomous AI agents finally come online?
It's a crazy thought.
We are used to humans using software to communicate with other humans. Are we prepared for a business world where the vast majority of commercial interactions, like, supply chain negotiations, legal document reviews, inventory routing, are actually autonomous AI programs negotiating directly with other AI programs in the invisible cloud, completely bypassing human interaction?
That is the invisible economy they are pouring the concrete for today.
Something to think about the next time you open a basic spreadsheet and wait for it to calculate. Thanks for joining us on this deep dive.